Drew, I'm going to start with you for a bit of an overview. You saw these things really taking off when you were in the States from what, about 2001 onwards?
That's correct.
Okay, tell us, because the joy about them is they give you diversity, but at low cost.
Absolutely. In 2001, I moved to the US from Hong Kong, where I was trading convertible bonds for Merrill Lynch, and they asked me to move to the States to trade these new products called ETFs. And I looked at the product and studied it, and I thought, well, what's the catch? These are simple funds that invest in underlying indices and use the physical underlying stocks at the time. And we saw the opportunities for these things to really explode in the market. So when I first started, there was probably 40 ETFs, and now we have thousands.
What about $2 trillion invested in ETFs now in the States?
Yeah.
Are they popular over here?
Yes, you have about 450 billion over here. And I think over here the stunting of the growth is more the fragmentation of the exchanges rather than the popularity of the product. So they will continue to grow here in Europe as well and elsewhere in the world.
And are they a good thing to look into in these economic conditions especially?
Well, in any economic conditions, the ETF should be considered a delivery vehicle. That's simply what it is. It is a transparent, low-cost delivery vehicle of an exposure. And the key question is, how does the ETF gain that exposure, and how does it track and deliver the performance of its stated underlying index is the evaluation process.
Jen, you've got about 30% of your equity allocation in ETFs, but you shift the proportions around. You're continually sort of looking.
Yes, that's right. I'm at Stanford Capital, which is a multi-county office, and we have a research team of 16 people analysing active managers, but we also use ETFs alongside. And it was interesting, I remember talking to a hedge fund manager with a very strong long-term track record and 10 exceptional analysts. And he said, I never listen to my analyst at two stages in the cycle. One is when the market has just bottomed and the market is picking up, because they're always the last people to hear that things are improving, because they keep on talking to their companies and finding that conditions are still very difficult, there are no sign of an upturn. So he says he completely ignores his analysts at that stage. And that is one of the times when we've deployed ETFs more heavily, because we think that for stock picking managers, when you just come out of a crisis, you want a lot of beta exposure, and a lot of the sort of active managers are still quite shell-shocked, and they're still owning a lot of the defensive stocks. And there are very few managers out there who will aggressively get into the sort of financially challenged metal bashers at that stage of the cycle, if that's what you need to own. So by putting more into ETFs at that stage of the cycle, that's definitely one time when it pays off. The other time, I think, is, I mean, just coming back to my discussion with this well-known hedge fund manager, who said in the middle stage of the cycle, very good environment for stock picking, active managers, adding value, and then towards the end of the cycle, stock market cycle, you find that the air gets quite thin and fewer sectors are participating in the move up in the market. And that again is a time when allocating to more heavily to ETFs can be quite useful. But in a bear market, there's quite a lot of evidence that more active managers outperform, so that's often a time.
Do we have a slide to illustrate that?
Funny enough, we do.
Exhibit
1, yes.
Let's see if I can find it, because they may just be in an order that is meant to be organic, so let's have a look.
I think that's not one.
Is that
might be it. Yeah, I mean, this is just a slide that really shows you that last year was a disastrous year for active managers in the US, and so I think the idea of this slide is to show you that that there are times to give up on active management, and this might not be the moment, because it's just been a very difficult time for active managers. One of the things that made it difficult for active managers last year was the fact that if you didn't own enough healthcare, if you didn't own enough utilities in the US, which were acting as bond proxies, if you didn't have enough in REITs, it was a pretty difficult environment for you. And it was one of those environments where the air had started to get a bit thin in the US. Fewer sectors were participating in the upside. Very good time to have higher exposure to ETFs. But over time, there are times when active managers can do reasonably well too.
Give us your full as a general overview of ETFs. How do you use them?
Okay, so ETFs we find particularly compelling, but let me give you a bit of background on how we got to that conclusion. So 4 years ago, I hired my CIO, John Moore Stanley, and we spent about a year going through all sorts of investment strategies. John has probably met with more than 1,200 fund managers over the past few years. So he had a lot of experience in various strategies, from macro to event to this to that. And I think the conclusion of that was very sadly that there's a lot of cynicism and not a lot of things work these days. And I think just bridging into the previous panel, in particular in this environment where we have equities at an all-time high and we have bond yields at an all-time low, it's very, very challenging. I mean, how do you find anything that kind of works on a sustainable basis? Anyway, we spent about a year going through all sorts of strategies because as a family office you can do whatever you want. And having thought very carefully about it and having also come to the conclusion that actually if you do invest in other managers, it is really the top 2% that generally can create long-term alpha in our view. So it's very, very hard to find the top 2. There's a lot of providers out there, but the top 2 is very hard to identify. We came to the conclusion that we like liquidity. We don't like to be locked up for 5 years. We run now 3 different strategies. One is an ETF strategy. Second one is a corporate high yield strategy. And the third one is a strategy that invests into emerging market funds, so locally based EM managers. So local Brazil, local Vietnam, etc., etc. Because we still think that there's an edge to be had there if you're a good manager. But the ETFs for us, which is core to our thinking, had some very, very compelling elements. First of all, they're liquid. Secondly, some of them, and we have sort of a pre-selected universe of ETFs, they do tend to trend quite well. So you can actually put a nice overlay on top of your ETF strategy that smoothens out volatility and therefore creates a very nice risk reward. Because it's all about, we were talking about what kind of returns do you want? Well, depending on what risk profile you have. You can, with ETFs, in our view, have a very, very nice diversified portfolio that sort of, it doesn't give you 100% put protection on the downside, but the good news compared to buying puts or absolute downside protection is this one is free. So this diversification is about the only free lunch you get in finance. And ETFs, being very diversified in their own right, and if you have a bunch of them, you're very, very well diversified. So from a downside point of view, and from a family office so that we don't like to lose money type of thing, it's great. It's liquid, so if you don't like it, you can go out, you can go into cash. And on the upside, if you know how to manage it, you know to pick the right things, and we build up a model that helps us do that, you know, the upside sort of take care of itself quite nicely. So you can actually get some very, very decent returns, high single-digit, low double-digit type of returns, which is fantastic on a liquid basis without having to be locked up in PE or VC type of stuff. That's why we found ETFs very, very compelling.
Yeah, can I just come in there for a moment? Because on the point of liquidity, I mean, obviously we use ETFs and there are definitely advantages, but we can't always say that they are liquid because in the crisis, as we know, there was one ETF provider whose name probably better not mention, otherwise might get sued. But they had AIG as their counterparty during the crisis, and trading stopped in their ETFs for about 4 or 5 weeks, if I remember correctly. And so it was absolutely frozen. And if a year or two before you looked at who the counterparty was and seen it was AIG, you would have thought that that would have been a reasonably solid firm to be backing it up. I think the other point is that there was a big US endowment who had a lot of capital calls for their private equity program. They couldn't liquidate some of their ETFs when they wanted to in the crisis because the ETFs they had were doing stock lending, and they found that they couldn't liquidate. So, I mean, you know, there are times.
Was that Harvard University on that one? Was that Harvard?
I
the wrong ETFs?
I don't want to sort of. It may have been one of those Cambridge-based universities.
And I think I can answer that in the sense that the ETF industry evolves and learns as well. So from that, we've seen a large amount of diversification in the counterparties involved in the underlying products, as well as the fact that a lot of ETFs in this day and age do not engage in stock lending, and this is part of a due diligence process that you would enter into. The key being understanding what the provider of the ETF engages in, how they get their exposure, and what other financial transactions they get involved in, such as stock lending, how many counterparties are involved, if it uses derivative products or swaps. In some cases, it is necessary to use swaps, but an evolution from that in this day and age is that the cash that goes into an ETF, in the case of some of our ETFs, simply is held at a third-party custodian and therefore is ring-fenced for the benefit of you, the unit holders of the ETFs. In the old days, it would be handed to the counterparty and you had exposure to the counterparty. So it's what they call an unfunded swap. So the cash is sitting there ring-fenced by the custodian for the benefit of the unit holders of the trust, and the counterparty exposures are actually very transparent. They're published daily by most of the ETF providers. So in the case of AIG, obviously it was extraordinary circumstances, but in this day and age, much has been done to mitigate risk, because you must, the primary goal of the ETF provider is to act in the best interest of the shareholders or the unit holders in the trust.
That's absolutely right. There was one other point I just wanted to make on that, which is that, you know, I think one of the other very interesting areas at the moment is factor ETFs and smart beta, and but one of the sort of potential pitfalls there is that if you buy a low volatility factor ETF, that will be based on what has been low volatility in the past. So if you buy a basket of stocks that have had low volatility, let's say utilities or bond proxies, those are the kind of things that would have given you, decent protection, low volatility in high-risk markets or with more volatile conditions. But I think that the risk is that if we get a big blow-up in the bond market, you could suddenly see all those areas that have had very low volatility in the past suddenly starting to have much higher volatility. And I think that past correlations are not always a good guide to the future, as we know. And so I think this is all an iterative process, and there are things that could still go wrong with ETFs.
We'll pause there for a second and get some feelings from the audience. So, would you put your hands up if you are already into ETFs? Let's see how many of you are into ETFs. Rare still over here at the moment. Put your hands down. Anybody considering getting into ETFs soon? Okay, so are there people in this audience therefore that are just not getting into ETFs? Okay, well, some people are agnostic here, clearly. Can I have some ideas as to why some of you have got into ETFs? There's a woman at the back in a red dress, combing her hair now. Go on, tell us how long you've been into ETFs and why, and how they've performed for you.
I did 3 years.
Please come to the microphone.
Oh,
Good. 3 years.
3 years, and you get a very good overall exposure. That you don't have any other charges really. But also be very careful the ETF the way you choose it, that it's very much a real one, but it's one that shadows. I don't know the technical terms, but I'm sure you know what I mean.
Yeah, that makes sense. It's a very good point. I mean, you want to make sure there's real underlying values underneath, or assets underneath, as it were. The problem with the ETF market is there's been such a proliferation of it, so there's so many of them now. And this brings us back to the problem of liquidity, because not all of them are, they trade by royal appointment. So what we do is we sort of have a pre-selected universe where we effectively screen which ETFs qualify. In order to get into that universe, or through that door, You need to be very liquid. It needs to be a real ETF, real assets. And then from that point, we have a sort of asset allocation where we look at commodity ETFs, real estate ETFs, bonds, equities, and then cash is always the sort of backdrop, as it were. So I think it is true, like it's being said here, you have to be careful which ones you select. We use a lot of US ETF because the liquidity profile tends to be higher. But you can, once you have that pre-selected universe, and once you sort of have a good model to help you select what's good and what's not, and your asset allocation, you can make very, very decent performance, and on a very liquid basis, which is very, very hard to find these days.
Cool.
So it really has some very unique and very attractive characteristics. I mean, compare this to, for instance, say you're running a stock portfolio of 15 stocks. Let's say 2 of them blow up or something happens, big profit warnings and that sort of thing. Ooh, you really feel it. The advantage if you have good ETFs is that you might have one ETF with underlying. And there might be GE and Microsoft and Apple and what have you. They're not all going to blow up at the same time. And if they do, we have a whole different problem. Do you know what I mean?
Yeah.
So it is really sort of quite safe. It is a little bit the downside protection, the free lunch, if you like. Not 100% full downside protection, but it does help a lot. Exactly what a family office likes.
Sure. Okay, so I like your pre-selected universe set of filters, as it were. Drew, you've got 3 good guidelines as to who to choose, because there's a lot of them out there. What are your criteria?
Yeah, I think at the very starting point, you're looking at who the provider is. How big is the provider? How diversified is their product range? How profitable they are? Look at their track record of maintaining the ETFs in the market. How often do they have to close ETFs? So a smaller operation that doesn't have the revenue to fund the growth of new ETFs may have a sort of a faster hook on those products, and you don't want that happening with something you're invested in having to realise capital gains or something like that. So larger ETF providers have a diversified range of products. Number 2, the primary goal for me is to understand what the index methodology is and how does the ETF achieve its returns to match that index. Many ETFs are optimized, some use derivatives, some use physical, which we talked about. In many cases, swaps and futures may be necessary, especially in the commodities space. How well does the manager manage capital gains within the funds? And then thirdly, what are any other financial transactions that the funds enter into, i.e. sec lending or things like that. So the key is the provider, how does the fund generate its returns, and does it engage in any other activity? So they're the 3 I start with as a due diligence process, and you might have a few others that you apply in your process as well.
In a moment, we'll hear maybe about your quant system as well, which I think is
I'll flip back also to one other I didn't mention is that we just talked about, liquidity. So the liquidity is crucial, and you must look through to the underlying liquidity. I had a classic example during the GFC when I was running ETF trading at Citigroup in New York at the time, and a very, very large fixed income mutual fund rang me up from Boston, and the market was obviously in free fall in some cases, and there was a high yield ETF that was just launched by iShares at the time. And he rang me up and he said, Drew, I heard about these ETFs, they're very liquid. How do I get short $1 billion of this ETF? And I said, why don't you get short the underlying high yield bonds that the ETF is based on? He said, well, I can't sell any of them, there's no bid. I said, well, what makes you think there's a bid in the ETF? So the ETF is a mirror of the underlying assets it buys. That's the number one thing. In some cases, ETFs become more liquid than their underlying portfolios. If you look at the emerging markets ETFs, they trade per day far more liquid than if you attempted to do the baskets, because you'd have to go overnight. But at the end of the day, if the liquidity dries up in the market in that ETF, it will always fall back to what is the underlying liquidity of the underlying assets. And another example is a Canadian pension fund rang me and said, Drew, I've got a problem. Only 25,000 shares of this financials ETF have traded in the first hour of the day. This is obviously prior to the GFC. And I said, well, what's your problem? He said, well, I want to invest $50 million in the XLF, which is the US one, which was the financials ETF. I said, hang on a second. I said, look, the price on it is, say, 15 cents, 17 cents bid offer. I said, I'll stop you at 17 cents and I'll go buy it. I immediately released a portfolio of the underlying stocks to buy them all at the offer. It immediately sent me back within 20 seconds the NAV at which I bought that underlying portfolio, and I rang him up and I said, here's your $50 million of financials at 17 cents, and we didn't even move the market because of the liquidity of the underlying. And that was a lesson for that gentleman in understanding, the underlying liquidity drives the liquidity of the ETF.
James, every time we mention liquidity, you twitch a bit. Go on.
I think I made some points on liquidity in sort of extreme situations, so I don't want to rehash them necessarily.
Fair enough. Yeah, but we know where you stand. Yeah. Per, tell us about this quant model that you use to assess.
Well, it's a model we built up ourselves. There's two aspects to it. There is the actual NAV calculators on the ETF itself, and then there's the overlay. And maybe we can take one of the slides.
Retrieve my device here.
What the overlay sort of does to you, which is very further back. There we go. So if you look at the green line, that's sort of our, that's our drawdowns. So this is when we lose money. Everybody hates losing money. Family office hate losing money. This is sort of when we lose money. The blue one is the market. So when the markets are down, as you see in 2007 and 8, there's some very, very big drawdowns in the market. By putting this kind of trend following overlay on top of it, where basically you smoothen out the volatility, you chop off the worst part of the downside. And the whole philosophy is if you can manage your downside, i.e. when markets are falling or things are going bad, and you chop off that bit, the upside will take care of itself. That's exactly what happens there. So whenever markets lose money, we lose less. That's the whole trick. Chopping that off through that overlay. And if you go to the next slide, you can see what that sort of does performance-wise. This is in US dollars. The blue line is sort of our performance since December 11. So it gives sort of a nice sort of, not completely steady eddy, but it does jump around. But when the markets are bumping around, like you see here, we bump around less. So it brings down volatility, it brings down the risk profile, and yet you still get a decent sort of, 12, 13% annual return, which is not very easy to come by these days. Now this is in US dollars, and yet the currency effect, because we now do euros, if we take the next one, we get an added benefit as well, then it looks even better. But that's just currency. But the key thing is, if you have those two components, where you have this diversified universe of the right ETFs, and you have the right overlay on top of it, you really have a magic formula for what is, in our view, a truly sustainable model of managing the core part, not all part of your assets, but the core part of the assets.
James, we've been talking about these as being very low cost, but you cautioned that people look at the total costs involved of investing in this sector. Run us through that.
Yes, I think you need to look at the overall cost, not just the sort of management fees, and obviously smart beta factory ETFs. There's some extra sort of costs involved in that, but yes, they're just important to make sure that the overall cost, not just the management fee.
And there's a very good example of that in terms of total cost analysis. Is if you're looking at, for example, there was a Vanguard ETF in the early days in emerging markets, and talking about the US markets, and there was an iShares ETF, and the iShares ETF was substantially more expensive from an MER perspective, total expense ratio perspective. But at the particular time, the iShares ETF traded a substantial amount on very tight spreads, whereas the Vanguard ETF traded on very wide spreads. So the spreads you're crossing and the liquidity of that ETF and the commission charges in doing so are also have to be factored in on top of the total expense ratio that James is talking about. Secondarily, and I'm talking about a small portion of the market, because the bulk of ETFs are physical replication. Because in the case of some of the swap-based commodity ETFs, which are typically in the commodity space, that swap will have an embedded financing cost, and that will be coming out of the NAV, so it won't necessarily be apparent to you. But understand that that is also part of the total cost for that product.
Yeah. And would you say, Drew, that index funds, let's say a BlackRock index fund, would be normally cheaper than a BlackRock ETF? So, and the difference being that the index fund would trade once a day, whereas the ETF would trade throughout the session. We've sort of noticed that there seems to be cheaper if you're prepared to only trade once a day in a fund.
Yeah, there are cases where a fund, an index mutual fund, has lower fees than an ETF. It's rare, but there are definitely cases where that's the case. But the real thing is, if you look at something that you will talk about is versus active management, ETFs simply deliver a beta exposure at a far lower cost. And now the other thing is you're going to see active funds active strategies being bought out in the ETF vehicle. The question is that the problem is they won't have necessarily the same transparency as a standard index ETF, and the fees will be higher. So, once again,
And will they become less and less of an alternative then to as a
yeah.
result of it?
But in the current portfolio, there's also, it's not just allocating, for example, I spoke to a model portfolio manager the other day, and they said the way we work is we've changed the way we do things. Typically we spent all our time trying to choose the correct active manager. And if you can, I agree, there are some good active managers out there. But in this day and age, what they do now is they spend more of their time deciding on the top-down asset allocation of the overall portfolio, and then they fill it bottom up with either an active fund or an ETF. So the choice is there for you. So ETFs simply have really provided a larger degree of flexibility to how you manage portfolios.
Yeah. Just coming back to one of the topics we had earlier, where we were discussing the potential returns over the next 10 years. I was at a BlackRock conference last week, and they were saying, look, if you've got a 65% equity portfolio, 35% bonds, the expected returns you're going to get are going to be 2% real for the next 10 years. And usually BlackRock are more on the sort of upbeat side of the spectrum, so maybe there was something in their coffee that morning that wasn't quite right. But I think that one of the issues with that is that, yes, index funds are going to help you keep the fees very low, but a lot of people will say, well, I'd like to try and get some alpha into the portfolios to supplement that 2% real return, because we know that the returns from the market, are going to be pretty mediocre. So what we try and do is we have these through the cycle managers who've got good long-term track records of outperforming the various indices with low volatility over the cycle since 06-07. And then we combine those managers, those sort of high alpha through the cycle managers with ETFs to keep the cost down. That way, we're hoping we can get some slightly higher alpha for our clients.
We're asked in our programme there to analyse whether in fact ETFs kill mutual funds to a degree. Is this a paradigm shift, the question asked? What's your position? Are these absolutely so much the best things since sliced bread that they kill older ideas, perhaps?
No, I think there's a great market for mutual funds and UCITS and retail product type of thing, but it's for a family office that doesn't need that daily liquidity, and that drag on performance that creates, quite frankly, we're not very interested in it. So I think there's a different audience for that, and that will still continue. It's a big market, and that's not going to go away anytime soon. But it does provide you with a low-cost alternative to get market exposure, and which is fantastic because it does increase competition, if you like, in that regard. So ETF, they're here to stay. They have a great.
But mutuals still have skill too.
I think where the managers can prove a certain amount of skill over the cycle, then that's worth combining with.
True.
And I think one of the things is that most of the people I speak to have a combination portfolio. There are a lot of ETF only portfolios now being managed, but there's also the benefit of the transitionary role that ETFs can play. Quite often we see, as people wish to allocate to a certain asset class, they are searching for the correct active manager. They can simply use the ETF as the transitionary exposure at a low cost to that asset class and give themselves time to find that manager. And quite often they might end up, that can actually extend the search period so that they can have the flexibility to really do their due diligence and find a quality manager whilst maintaining exposure.
Well, let's take some final questions from the audience. We've got about 5 minutes. This gentleman in the blue tie there, just sitting there, and let's have another couple of the gentleman that we spoke earlier here is wearing the gold tie. You're first.
Yeah, Edwin Wolfson, Stella.
Say that once more. We'll have you your volume up. Here we go.
Hello. Edwin Wolfson, Stella. Going back to a question you raised, Tim, in the previous panel about are we laying the seeds of the next distress crisis, and extrapolating the point that James made about the illiquid AIG ETF example, and mindful of the huge amount of money that's gone into the ETF sector, to what extent could this whole sector be the source or be the place where the major distress will happen in another 2008? Illiquidity, wanting to cash in at once, no gates.
Well, you've just made Drew look very sad there. Go on.
I'm not quite how to take that one. A fair point, and there might be, if we were to enter into a 07 sort of environment again, that there might be people who are into some of the more exotic part of the ETF world, they'll get stuck. Absolutely. I don't think it's going to be what drives down the whole building. There's a lot more candidates for that in terms of what's being built up out there of things. I think obviously now that the banks are not lending anymore and Basel III and all that sort of stuff is still kicking in. But there will be other candidates in the future, no doubt. One of the areas that we sort of keep a close eye on, not from an investment point of view, but which in our view needs to be a lot more regulated, is the whole crowdfunding space and all that sort of money that goes into it seems to be completely unregulated, and there's going to be a lot more pain there. It's not going to bring down the building, but I think that would be a more obvious area to look at. There's also areas within green energy where there's a lot of government subsidies that are being pumped heavily and almost in a religious way into projects that will never be commercially sustainable. And those projects tend to have 90% leverage attached to them. So there's going to be a lot of pain there. Not for the whole sector. I mean, there'll be great wind projects and solar projects and hydro projects, but there's also things like tidal and things like that's going to be a disaster. So there will be pain to be felt, but I don't think ETFs will be the first one that's going to cause the trouble.
Just coming back on the question as well, I mean, I think that if you look at the trading desks within these investment banks, they've all been told, that they can't take as much risk as they used to. And so, I think in any kind of stress situation, you're not going to see the kind of liquidity that was there before, and that's going to be the physical market and the ETF market.
The gentleman.
Well, it's one of the partners. With the explosive growth that's taken place in ETFs, there's also been explosive growth in the trading of high-frequency traders. Some people have said that the HFTs are getting a lot of their lunch, making a lot of their money off of the back of the ETFs. I'd like to hear if the panel think there's any substance to that.
I think that's it's a factor of they're doing it across all stocks, all listed securities. So it's a speed factor with the high frequency traders. Whether they're going to be using these engines to make money out of GE versus the SPY is still down to their models and their speed. The fact that ETFs trading volume is so large, obviously that's where they're making a lot of money, because in certain times during recent years you've seen ETFs be 40%, and in times where volatility spikes, ETFs have been as high as 45% of the total trading volume of the American stock exchanges. And that's because, number one, from back in the days when I was trading it, immediately the people wishing to hedge will go to the most liquid product they can get liquidity in, and usually they'll head for the ETF first to try and put some sort of overlay hedge on or move their risk. High frequency traders simply will go towards the most turned over vehicles in the market to try and make their money out of their speed. So it's not really the cause from ETFs, it's just whatever the top 10's trading stocks or top 20 trading stocks, which a lot of them are ETFs, that's where they'll put their engines to try and get their slice of the pie. And the other thing is, whenever an ETF trades, they'll be looking to trade against it, the underlying basket. So they're looking at both sides. So that adds to in an extent, they add to the liquidity of ETFs because of the fact that they can trade with such frequency on the underlying versus the ETF. But it's not ETF driven, it's what's the most turned over products, that's what they're looking for. And I go back quickly to the flash crash. Many people talk about ETFs and the flash crash. The ETF NAV will follow the underlying portfolio's value, whichever way it goes. So the flash crash triggered by futures start moving the market down at a velocity that's unprecedented. Then stocks are trying to catch up, and the ETF NAVs are trying to catch up with the stocks. And me as a trader, and when I'm sitting there, I'm not going to get the liquidity in a single stock to try and get my hedge in this scenario. I'm going to go after the ETF where I can actually get some liquidity and get something done. So they're all triggered from each other. The ETF is once again the mirror reflecting whatever the underlying exposure is doing. So hopefully that answers some of it.
I think we've got time for one more question, if we have one. If not to worry. Let's see, anyone out there? Last chance. Well, I tell you what, I learned a lot of things that I think we all did. Very useful information. So could we have a good round of applause, please, for Per Wimmer and Paul Wood?